Welcome back to the Long Call Option Masterclass. I'm Stephen Cox, CEO and full-time financial trader. And at Share Navigator, we believe that education is financial trading power. This is the final episode of our 6-episode masterclass, where we continue our in-depth analysis of the long call strategy using the Apple $240 call option as our active example. So if you like this content and you want us to continue to create more content, please like, share, and subscribe. And also, if you have any questions, please post in the comments section, or you can reach out to us. Our contact details will be at the end of this video. To quickly recap, on October the 17th, when Apple was trading at $252.40, we bought the $240 call option, expiring in 90 days for a cost of $2,215. In our previous episodes, which you can go back upon, and we'd encourage you to do so, we discussed the basics of the Apple long call contract. We discussed profit and loss scenarios, and we benchmarked buying a call option versus simply buying a stock. We also discussed the Greeks, delta, theta, gamma, and vega. Today, we move from theory into trade application and trade management. And we encourage you to watch this video over and over again. We were going to give you tips and insights as to what you should look out for if you actually go to apply the long call strategy for real in your account. So you're looking at your typical option quote screen. And as you can see at the top here, we've got our expiry dates. On the left-hand side, you're looking at the call options here. Now, typically in a full screen, you will see calls on the left, puts on the right, but the strike prices down the middle, as you can see here. And then we've got all of our Greeks uploaded with our bid-ask prices. So as a rule of thumb for you guys when buying call options, try and pick expiries with about 90 days or more. The reason for that is we want to avoid that Theta decay trap that we spoke about in an earlier video. Pick strike prices that have a delta of a 0.7. So they're going to be in the money. They'll be slightly more expensive, but you will have a better chance of having some sort of value at expiry if you do that. And then finally, try and choose strike prices that have narrow bid-ask spreads. So you can see the bid-ask spread here between the 240 call is 21.70 and 22.15. The wider that is, the harder it is for you to make money, because when you go to sell it, you're getting the worst price possible. So try to keep those bid-ask spreads narrow. And we're going to show you how to haggle with the market when you're actually buying the call option in a later section in this video. Again, every broker will have a slightly different setup, but generally what you do is click on the ask price in order to start the order. So we're going to click on the ask price for the January 16, $240 call, and we're going to be brought to the order window. So from here on in, we're going to teach you from the Interactive Brokers client portal. We have to choose one broker to use to demonstrate. So this is typically what you're going to see, and we're going to talk you through each section of this before we go and place this order. So talking you through the first order window, you can see first up is just a description of the trade, which we're buying the January 16th, 2026 $240 call option. You will also see the order button on the top right in blue. And when you go to place the actual trade, you'll click on that button. But let's talk you through the rest first. You'll also see the bid, ask, and mid prices. This is important because we're going to haggle with the market. We're going to always look for the mid price if we can. And then finally, we can see there's another description of the trade. So it's just reminding you that it's actually the trade that you want to place. Next up in that screen is the performance profile. And this is brilliant. This is going to tell you what your break-even price, what your max profit and max loss data is. So you can see here for the Apple trade, our max loss is $2,215. That's what we're paying for the call option. Our break-even price is $262.38. And our max return is said to be infinity. In other words, the more the share price goes up, the more profit we make. So a great example here of just all the calculations being done for you. We told you that in previous videos that this would all be done for you, but it's still important for you to understand how we get to this point. Also, the probability of profit there you can see is 41%. Now, again, just a reminder, if you bought the stock, your probability of profit will be 50%. The reason it's 41%, as you can see, is that the break-even price is higher than where the current stock price is at the moment. So in other words, at expiry, Apple share price needs to rise by $10 just to break even in this particular call option trade. So that's the trade-off. Because of the time value you're buying in the option, we know it's cheaper. You know, if you were to buy 100 shares of Apple, it costs you over $25,000. Here you're only forking out $2,200. The downside is you need the share price to move upwards in order for you to break even at expiry. So now we're going to look at different scenarios of what could potentially happen in terms of profit and loss with this particular trade. The next section in the order window is a great feature, and it's something probably people don't make enough use of. So what it does is give you a profit and loss dynamics for particular outcomes in the share price, and it automatically defaults to the expiry date. It also tells you what your delta and your theta is there. So this is telling you at this minute in time what your profit and loss would be for a 5% move up or down at expiry. And as you can see, if the share price of Apple moves up by 1% at expiry, we would actually lose in this trade $721. That goes to show you it needs to move up more. But if it moved up 5%, we would make $288. But watch what happens. And this is a great feature in this. We can change the last trade date. What if it made those moves in the next week or two, for example? The profit and loss dynamics will change. So we've changed the last trade date to November the 20th here. So now it's going to give us the exact same P&L tables, but you're going to see different values here. And the reason for that is there's still time value left in this option. So the Greeks are still at work. So therefore, the profit and loss numbers will be different. So you can see, for example, for a 5% move up in the next 3 weeks, we'd actually make $694, a lot greater than at expiry where it was only $288. And as a reminder, again, there's still time value left in the option. And that's the reason why it's more valuable on November 20th than it is at expiry in January 2026. Also with this system, it's going to change the Greeks. We talked about gamma and vega and all the gas pedal of delta. So as the share price is moving, the Greeks are always changing as well, and it's calculating that for you there as well. So it's a great feature within the tool, and it saves you having to do all of that math. If you're happy with the order summary window and you're ready to go and place the trade, you click on the blue order button on the top right-hand corner, and it'll bring you to the following screen. The first half of the order window reminds you again of the trade you're placing, just to be certain, and it also highlights whether you're buying or selling. It's important to double check that. This is where you can actually make a mistake and sell the option instead of buying it. So it's a great little summary feature for you. The middle window is where you set the trade parameters. Quantity is the amount of contracts that you want to buy. It will default to 1, but you can change that to 2, 3, or 4, depending on how many contracts you want to buy. The next section is important, which is the order type. We recommend you choose a limit price, and the limit price is where you're dictating to the market maker how much you're prepared to pay for this particular call option. And that will save you from getting an unfavorable price if there is wide bid-ask spreads. If you choose market, it will just get filled at the next available price, and sometimes you get an unfavorable price when you do it that way. And finally, the time in force is good till cancelled. So if you're going to lose a limit order, you got to use a good till cancel order, which means that the order will stay in the system until the order gets filled, or if 6 months pass, whichever comes first. We would only use a day order here, which means the order stays in the system for just 1 day. If we were doing a market order, we wouldn't use a day order if we're doing a limit price. When you click on buy order, the preview screen looks like this. And again, it's just reminding you of the trade you're about to place. If you're happy to place it, just click on submit buy order. So now that you have your long call option in Apple, what should you do? Well, if it goes up for you, great. But we think you should sell if you get to 50% profit. So what we mean by that is you pay 22 for the long call. If it goes up by $11 to 33 to 38, for example, sell. Remember, time is ticking and the stock can reverse at times as well. So it's important to note that. If the share price doesn't move up or even starts to fall, you have two choices. If you're still bullish, sell your existing call option and roll it out to a longer time frame to avoid Theta decay. Remember, that's the enemy of long call option buyers. And if you've changed your mind and you no longer believe, just sell the call option and put it down to a loss. Take the hit early. It's important you can learn how to do that as well. And finally, remember, asset allocation. Do not put all of your eggs in one basket because you can lose 100% of your capital. So that's it for the long call option masterclass. I hope you found it really informative and enjoyable. If you did, please like, subscribe and share to our channel. Also, feel free to post any comments and reach out to us via email. We'd be happy to answer any questions that you may have. And finally, we'd encourage you to take advantage of our mentoring service. We start you off with a free trial, so there's no cost to you, no obligation. You can have one free session with me, and it simply is the best way for you to learn. It will help you avoid all the common mistakes that people normally make when starting to trade options.